October 13th, 2023. Today we got a measured move down, or a leg one, leg two measured move. You can see from yesterday, this is the second leg. Whenever you get a strong spike like this, it's probably going to be enough for a second leg. And you can see we got a big move down, two-legged pullback, and then a second leg down, which is essentially what the entire day was. Additionally, I mentioned yesterday that I thought this high was going to be really important and we might have to vacuum down to it. And that's pretty much exactly what we did. You can see we found buyers there on 20. And something that's really important to note is that, so if you just look up until bar 13, right here, you can see this is a reversal attempt. Bulls are, they're trying to get a bull flag. Bulls are attempting to get a bull flag, and they want to get a bull flag and a breakout to the upside and a measured move up. But if that bull flag fails, we could get a breakout to the downside. And so when you see 14, you have to be thinking that we might get a measured move down of the bull flag. And where does that take us? The measured move down. There's this one you can use with just the bodies if you wanted to, or you could use the one with the tails, which seems to make more logical sense because the one with the tails leads to another exact magnet. And that's, it's not random. That's why it's placed there by the computers. They see the measured move and they know that there's reasonable risk reward to sell below 14 for a swing down to this high. So it's really not random that that this measured move was exactly this large and exactly to that high yesterday. It's all, meticulously placed. This is my, I always do these for the days. Let me know if you guys, it's always the thumbnail. It's just like my daily analysis that I do on the day, but it's always the thumbnail of the video. So let me know if you guys want me to show them in the future every day. I can start out with that if, that's what people want. Bar one, bull bar with a big tail on the top. There were sellers. As we started to rally higher, in general up here, it's better to be resistant to buying because we're overall in a trading range and you're buying towards the top of the trading range. You don't really want to do that unless it's really strong. So 2, bad follow through. It's an outside up bar, but a big tail on the top and a big tail on the bottom. So not really worth taking there. 3, it's a low one short, but probably not very good. This was strong enough for a second leg up. So you got to be pretty careful selling below 3. 4, it's a high one, but you got to be thinking about how much follow through are we really going to get after 3. And if 4 is going to get follow through, what is it going to look like, right? If 4 is going to get follow through, bulls are going to be looking to get back to probably that low where other bulls got trapped. So you're probably just going to get a vacuum test of it or a vacuum test of this low. You want to race straight up if you're buying above 4 because it's a lower probability trade. And when you get a lower probability trade, you want, the goal in taking it is for it to turn into a high probability trade rather quickly. And because then you're in at a better price and you're now in a high probability trade. But when you get bad follow through on 5, now a lot of traders are like, well, I don't know. I mean, I thought we were going to race up, but we didn't. So a lot of those traders start scalping out, and that's what causes the outside down bar on 6. Bar 6 is a low 2 short, pretty much at the same price for traders who sold below 3. If you sold below 3, you're probably disappointed in 4 and 5. So it's hard to want to sell below 6, especially with the tail below it. But sometimes on bar 7, you get dramatic bars. And that was kind of a dramatic bar on 7, but it traded down, ends up finding buyers. And we get another push down on 8 and then a collapse on 9. And it looks bearish, but if you think about it, it's 1 pullback, 2 pullback, 3. So I didn't highlight the right parts. 1 pullback, tail of 7, 2 pullback, tail of 8, 3 push down on 9. So it's a parabolic wedge on a smaller time frame. So when you see all these tails and then a big drop, you have to be thinking potential parabolic wedge. We might have to bounce here. And that's exactly why 10 got bad follow through. You can see traders were not willing to sell below 10. There were buyers below 10. They were willing to sell above 10, but not below it, which tells you that limit order trader, limit order bears are going to be making money and stop order bears are probably not going to be making money. So essentially, those are my thoughts on 11. 12, it's a double bottom, but doesn't close near a tie. It's not a very good bar. And you end up getting good follow through on 13. But the problem with 13, well, it's an outside bar, so it's a reasonable buy. But this is pretty tight, so it might be a minor reversal. We might have to get back to the 5 low, but I think it's an okay buy above 13. And bears who are short for any reason in here know it's an okay buy above 13. So they're willing to exit above 13 if 13 triggers. And what they'll do is they'll basically sell the market with a stop that's 1 tick above 13. So they'll be risking essentially 2 ticks from their entry price. It's low probability, but occasionally when you're risking 2 ticks from your entry price, it's just going to sell off. And those bears, they're able to make a lot of money. So 13, you know that any bulls who are front running this or buying for any reason are disappointed in 14. So sorry, you know any bulls who are front running 13 are disappointed in 14, and they're going to exit below 14. And these are the trades that you want to take, where you know the other side has to exit. So if 13 triggers, it's okay to buy above because you know any bears in here have to exit above 13. If you're 14, you know that any bulls who have bought for any reason have to exit below 14. So that's a good sell. 40, you know any bears who or any bulls who are long anywhere in here have to exit below 40. It's a good sell. 15, it's follow through, but it's basically minimum follow through. If you're a bear and you sold below 14, you probably wanted a bigger bar. You probably wanted to see 16 or 17 right here instead of 15, like that size bar you wanted to see. But I have kind of more thoughts on that. I think that if you're selling 14, you need to think about the ideal follow through, the acceptable follow through, and just I need to get out. If you get any sort of bull close on 15, I think you got to just exit above it because there's too much chance that this is essentially a double bottom. I'm not sure it's the best buy above. It's low probability though, buying above 15 if it closes a bull bar because it doesn't quite flip the market to always in long. But it's probably it's definitely okay to exit above 15 if it closes strong. However, 15 closing as a doji, it tells you that there was some interest in selling, but it's not quite enough. But if you're selling below 14, your profit target is probably this high. And so you have, you're risking like 8 points to make 25. So you're it's essentially a 3-to-1 risk reward. So it's okay to give it a bar or two because sometimes with the low probability trades, they'll go a little more sideways first. And there are a couple ways to manage. If you see 15, a lot of traders will exit at the market and wait to see another bear bar closing below its midpoint, and then they'll sell again. So you can either sell 14, hold through 15, hold through 16, etc., or you can sell 14, disappointed in the close of 15 and exit. But if you do that, you have to sell again below 16. And that's why all those traders selling again below 16, that's what's going to cause this big dump on 17. You get some follow through on 18, and I think 19 is a really interesting bar. This is climactic and it's overdone for sure, but you have to be thinking that we're basically right at this high. We're only, 7 or 8 points away from it. And if we start to bounce, this is still going to be strong enough to get another leg down. So traders are still going to think we're going here. So a lot of traders, they're just going to sell the market at 19, knowing that we're probably just going to go right down here because there's too much edge. It's too likely that we're just going to touch this. And if we started to rally, those traders know they can just sell more. And since this was so strong, it should get a second leg. And so their premise that we're going to get to this high is still valid. So that's one of the reasons why we vacuum down here. And bulls know that. Bulls don't want to buy here. They know if they buy here, they're probably just going to lose money immediately. And if it starts to rally, it's probably a scalp at best. So it's really a high probability scalp for the bears. And that's why, a lot of those bears take it. And immediately they're buying back their shorts when they reach this high because the edge is gone. That was what their premise was. It finished and their premise is no longer valid. And so they're buying back their shorts quickly. 21, bad follow through for the high one buy on 20. 22, inside bar. I would probably just be flat. We have 3 straight dojis. It's a tight trading range. Probably better to just not be in a trade. Where was I? Sorry. 23, outside down, but after this tight trading range might be a final flag, and 23 is the final leg down. So you have to be careful. And if I was a bear, I would exit above 24. 24, some traders might buy it, but the problem is it's a minor reversal, right? This is so strong and tight that it's going to get another leg down. So best case for the bulls is 10 bars or 2 legs up and then probably a correction, which is essentially what we got here. We ended up getting one more leg down, but we essentially got that 10 bar 2-legged correction. And that's the best case for the bulls. So that's why buying above 24 really isn't all that great. You get bad follow through on 25. You can see traders who sold below 23 or the close of 23, disappointed 24, getting out during 25 as it tests down. And that's what's causing the rally. 26, bull bar, but you're back into a tight trading range here. Tight trading ranges are magnets, so the market gets pulled back into them. And if you think about it, 25 is a pause. So it's 1, pause, 2, 1, pause, 2. So it's 2 legs up. So not surprising, a lot of resistance up here, and just this in general, not a good idea to be long. Some bears will sell again below 27. You get good follow through 28 and a big climactic bar during 29. At this point, after this reversal, you got to start to think about, how much further down are we really going to go? I would be thinking that bulls who are going to buy below 24 are going to be able to scale in lower and make money. When I see 29, that's what I think. I think the bulls who buy here are not going to get trapped. And additionally, we have a lot of support coming up in the prior day's low. There's usually support at the prior day's low. And so that's what we ended up getting here, and we got a bounce. So bad follow through on 30. Any trader who sold 29, their premise was that this is still a strong bear trend. It's more likely a channel. They know that. But their premise was that we were going to break out to the downside of this channel. And there's only about a 25% chance of that happening. So when you see 30, that's not the bar you want to see. If you're selling below 29, you want to see another bar exactly like 29, and you just want to see it collapse. And when you don't get that on 30, a lot of those traders will just scalp out, and that's what causes the buying up on 31. Follow through on 32, so it's 1, pull back 2, and then you can see 33 tries to test the 30 high, but it's not quite able to. Bears disappointed that they weren't able to test this high, start to cover shorts, and bulls are buying the close of 33, trying not to let this trigger. And as it goes higher and higher, bears get more and more worried, and they start panicking out, and that's what causes 35 or 34, 35, 36, 37. Probably okay to buy the close of 35, I would think, but with how steep the bear channel was, I'm still expecting a second leg down. This reversal is probably minor, so you have to be careful. Every once in a while, we've had a few examples of it in the past a couple of weeks ago, where you'll get a relatively steep move down, and then it'll just rally. It wasn't obviously the same context, but occasionally it can go, and that's why some traders will buy 34 and 35, hoping to get in early on what ends up being a strong rally back up towards the high of the day. But when they see 38, they're disappointed, right? So they were hoping that we were just going to race straight up, and we don't. When you see 38, traders know that's not going to happen. And so on 39, you can see they're exiting right around break even. You buy the close to 38, you're disappointed. You buy the close to 37, you're disappointed 38. You get out during 39. And those traders getting out causes the big bear bar. Traders, you have some bulls trapped below 39, and then you see 40. A lot of the bulls who bought for any reason are disappointed at 40. They're going to exit below, and that's why you get big follow through on 41. But you can see a lot of the traders, they got a quick, 8 or 9 points down to the bottom, the open of the bull spike, essentially. So traders buying back shorts. Additionally, anyone who held, sold above 30 and held, they're pretty trapped. So they're happy to get out with a smaller loss. Inside bar 42, outside bar 43. Just tight trading range. It's still okay to be short from below 40, right? If you're an always in trader, you can sell below 40 and there's no real reason to exit. And you end up getting good follow through on 44 and 45. Still no reason to exit 46, 47. You could argue it's 1, 2, pull back 3. So it's 3 legs down, some sort of parabolic wedge. And you can argue 1, 2, 3, 4, and that's why, and then a double bottom. So a double bottom parabolic wedge. Not surprising, a lot of bears covered shorts and caused 51. But that's what's happening on 51. It's bears covering shorts. It's really probably not very many bulls buying. And bears covering shorts is why it ends up just going sideways. If bulls were really interested in buying down here, we probably would have rallied a lot stronger. But this is just a short covering bar. 40. So like I was saying, 45, we get a failed breakout. Basically, bears wanted consecutive closes with a new low. They don't get it. We get a tight trading range here, which is probably a final flag. And then, one of the best bear bars, look at the size. It's 10-point bar. When was the last time we had a 10-point bear bar closing near or on its low? Maybe here, but that was, 20 bars ago. So we're really deep in this trend, and you're getting a big bar after a potential final flag. I think it's okay to exit on the close of 48. But if you're an always in trader, you don't have to exit on the close of 48. You can stay short. And then you get 49 and 50, and it's a micro double bottom. You can see traders, anyone who sold the close of 48, disappointed in 49, is buying back their shorts as 50 is rallying. Because they were disappointed in 49, they wanted, the market to collapse, and it didn't. And they're buying back shorts. Some traders will buy back shorts right above 50. Some traders will do a measured move of 50 up. But regardless, traders are buying back shorts, and this causes the big rally on 51. Bad follow through on 52. Anyone who bought for any reason, probably scalping out and going to cause us to go more sideways. You don't want to trade in this. I know it's tempting, but you really don't. It's just too sideways. I would say the things to note are bears have a magnet here. And you can see we actually tested it. That's what 75 was doing. It was dipping down to let the traders who sold above here, to let them out at break even because they did a reasonable thing. Bulls who bought below 39 probably did a reasonable thing, but their argument is not as strong because this is a big bear day. So we end up going sideways. It's, a low 1 below 53. You get follow through, but it's likely to be bad. Trading ranges are going to run bad stops, right? If you sell below 54, you put your stop here, it's getting run. If you sell below 60 or 59, you put your stop up here, it's getting run. You buy above 60, you put your stop down here, it's getting run. Trading ranges love to run, tight stops and stops that work in trends. Like if you sell below 14, stop above 14. You sell below 40, stop above 40 or above, 37. And trading ranges love to run those types of stops. That's generally what they do. And so that's why it's better just to not trade. And, 59, it's a wedge. You could argue that, it's, generally a bear day, but 51 creates a big problem for you. But it's still, overall a bearish day. And you could say first pullback, second pullback, third pullback, wedge on 59. But it's a tight trading range. And in tight trading ranges, wedges often fail. And that's why we get what happened on 60. And you could buy above 60, citing that 51 should get a second leg up. And you're not wrong. And it's still a wedge in the other direction too. 1, 2, 3, 4. It's a wedge in the other direction, but it's still a tight trading range. And the problem with buying above 60 is most swings turn into scalps. And so you're going to end up having to scalp out high here for 5 points a lot of the time, which is exactly what happened. And so it's just really hard to manage that type of trade if you're buying above 60. You can do it, but if it goes against you, you need to be willing to scale in lower. And a lot of times you're going to have to scalp out if it goes right for you. So it's a hard trade to take. And trader scalping out is what's going to cause the big bar on 62, right? And it's important to realize that in trading ranges, traders taking profits, it's what causes the big moves, or not, taking profits or panicking out of trades, right? If you sold below 59, those bears panicking out of the trade above 60, you get a big bar on 60, but traders scalp out quickly. It's causing the big move down. So, essentially profit taking and loss covering is what's causing a lot of the big moves up and down in trading ranges, not necessarily, like bears just selling this close. There are some bears who will sell that close, or bulls will buy below this. There are some traders doing that, but it's not as common for the reason as to why the market is moving the way it's moving. 64, or I think it was on 63. Some follow through for the bears, but not breaking out of the tight trading range. It's an expanding triangle, final flag, which means that, in general, well, I'll get to that in a second, but it's a final flag. You could argue it's a final flag for the bulls with how big this bar is. You could argue it's a bull trend, a final flag, and we're continue down. But I think that with this being a pretty overdone bear move overall, this is probably a final flag for the bears, and we might try to get some sort of rally on Monday. I would think at least we're gonna make an attempt. It might not happen, but I think bulls are at least gonna try. And I thought that you could buy above 65, hoping that rally was going to start and maybe get back to the 39 low where bulls got trapped. And you get some follow through on 66 to 67, but it's just not good enough. There are big tails on all these. If you're buying above 65, you really want big follow through. And traders scalping out up here, disappointed, basically scalping out around the close of 61. They're disappointed, and that's what's causing this. And, the bulls who bought the close of 61, they're interested to see what's happening with 65. If we just start to rally, you buy above 65 and we start to rally and we get strong closes, they're not going to exit. But since we get a weak follow through bar 66, 67, those traders are flattening, and that's what's causing 68. Second leg up, 69 ends up being a second leg trap. Again, some traders were buying during the breakout above 61, hoping that we're going to race to the 39 low. And when they're disappointed in the tail on 69, they exit at the market causing 70 and get a couple legs down to the end of the day. For trading, trades, I did not really like 9. I thought it was too much chance of being a parabolic wedge. If 13 triggered, I thought it was fine. I think 14 is a good swing trade for a measured move. You can sell the close of 16, 17, 18, 19, whatever, looking to get to here. Always in, if you're just literally trading always in, you probably have to exit above 24, but you don't necessarily have to exit until then. If you're exiting at this high, it's a profit maximization thing. It's not an always in thing. Profit maximization is like, you're just you're trying to maximize your profits, obviously, but you're trying to get out high, or in this case, high at the top of trading range, or in this case, you're trying to get out low, betting that we're going to form a trading range here, but you're not totally sure. Versus 24, you obviously have to get out above. They can sell again below 27, 28, but probably get out a couple points above 30. This is pretty overdone, so it's worrisome. Maybe you can buy above 34. Definitely get out below 40, and traders can sell below 40. Get out above this double bottom. I probably wouldn't buy, but maybe someday when I'm that good. I don't think anything really good to do in here. The stop order trades just aren't all that good. On the daily chart, I think we might get 2 legs down to this high. I think this high is going to be important. I think we'll probably find buyers when we get there, but we'll see. In the weekly chart, the buyers above here ended up scalping out. It's just a disappointing, it's a disappointing bar for the bulls. We'll probably get another leg down, so we'll probably get some sort of 3 legs down and maybe attempt at a wedge bottom. Or maybe next week we'll trade down and then rally up and try to essentially form a micro double bottom or something like that. Yeah,